Good afternoon. Welcome, Eduardo, to the Rivers fortnightly market update and discussion on our positioning. It comes at a good time. We've just gone through 10 years of managing portfolios in this way. Not 10 years of videos, you'll be pleased to hear, but 10 years of asset allocation and managing the Rivers model portfolios. If we look at the Rivers balanced risk model portfolio, over the last 10 years, we can see we've achieved the objectives of the portfolio with an annualized return over those 10 years of 7.6%, with a target of between 5 and 7%. We've exceeded the target. We've also done it at a lower level of risk. What's interesting, if you look at this chart, and just to explain it briefly, the blue line is the Rivers portfolio. There's a couple of benchmarks on there. The thing behind it, the kind of skyscrapers, is the level of tactical or risk level that we've taken, our macro view on the world. Now, if we look at that over the 10 years, we can see with 4 being neutral, we spend much of the time being underweight risk. And we went overweight risk only during just in the aftermath of COVID in 2020. But other than that, we've been either neutral or underweight risk. Now, how do you think that's affected our performance? Do you think our performance would have been better had we been at a neutral level of risk? And how does being underweight risk, how would you translate that into the process that we've got here at Rivers?
Right, so that's a very good question. And intuitively, one would normally think the more risk you take, the better returns you make. And if you deploy that risk properly, you can even increase your risk-adjusted returns. I think in our case, it's been a number of factors that have contributed to it. First of all, our process leads us to look for areas which are demonstrably lower risk, i.e. lower valuation, but present positive opportunities. And that's what we do. And there has been that quite a lot in the last 10 years. There's been non-correlating sectors, at least sectors that don't correlate with the normally historically risky sectors, which we've been avoided, and they've done well. So that's partly that. And another factor is a bit like the anecdote. If somebody said to you, there's a £5 note on a railway track, and trains, by the way, pass every hour. And on that railway track, there's a £10 note, and trains pass by 3 times as much as the one on the £5 note track. Which one would you choose? I would choose the £5 note one because I've got less risk, much less risk of chance of dying. And if I double my money, I triple my chance of dying. So I'm going to choose the £5 note. But that means I've underperformed the guy who's got lucky and picked up the £10 note. So that's kind of similar. Again, we would have had to take more risk. I suspect it would have had a greater negative effect on our risk-adjusted returns, but it might have improved our nominal returns. But we're here to produce decent risk-adjusted returns within, as you rightly said, the targets of each strategic portfolio balance, low risk or high risk. So I think those are the main drivers.
Yeah, I mean, I think it's interesting. We launched these portfolios in the aftermath of the Brexit vote. There's obviously been some political instability over the last 10 years and all across the world. But there has been a kind of relentless growth in US equities, let's say. And what's interesting is we look more recently. Since October last year, we've been at what we would call a risk level 2, which is underweight market risk. From a 4 would be neutral. We've been at a 2. We've been invested more in diversifiers and looking for opportunities which aren't necessarily related to the big AI stocks and the rallying market in the US. But what's interesting is over that time, our performance has been pretty strong. We've outperformed most general benchmarks, and we've done it at a lower level of risk. How do you account for that? And how do you think our positioning now, which remains relatively cautious, looking forward, particularly in light of what's been happening in the very short term, with re-escalation of hostilities in Iran and the somewhat turnaround in the fortunes of semiconductors and AI stocks?
So I think throughout history and throughout the 10 years that we've been running the money, things happen, right? Whether it's the Iran thing, or whether it's the Ukraine thing, or whether it's some other thing, the COVID thing, there's always something that happens from time to time, and that creates market volatility, and usually to the downside, and that creates an opportunity to go in, which is often quite a difficult one, because emotionally most people aren't prepared for that. And we do it because we have a process that drives us to do that, because we're driven by valuation, not by emotion. So that volatility driven occurrences help us, usually because we're underweight going into them, and because we tend to increase risk as markets fall. We tend to increase risk into that because the valuations are in our favor. So that's driven our returns to a degree. I think also the non-correlated sectors that we've been in, or the diversifiers as you call them, and to a degree how we've shifted from long and short duration in anchors has helped us. And finally, the areas that we've avoided, which are high valuation, for example, this year haven't actually done that well. Most people would think Microsoft and Google and Meta and all these stocks have done really well. They haven't. They've corrected between 20 and 40% in some cases. They just haven't had a huge impact on the index, weirdly, because as you said earlier, the semiconductors had such a huge run. So again, would we have chosen semiconductors as a place to deploy our capital? Well, possibly. It was a small sector until it became a big AI pick and shovel, I suppose you could call it. And most people would have gone into would have chosen tech, in which case they wouldn't have done so well. But if you'd chosen semiconductors specifically, then yes, you would have. But again, that's rear view mirror investing, and consequently not actually that helpful. What we've done is we've invested in those areas which are quite low valuation, presented opportunities. They've done on the whole reasonably well. Healthcare is probably the most recent one, and is one which we have, until it becomes overvalued, we think presents a pretty good prospect.
I mean, talking about valuations, we often cite, and I think in 2021 we cited the Cape-Shiller multiple, which is the kind of looking at the strategic multiple of the market based on the last 10 years of earnings, and so it tries to take out the earnings cycle. In 2021, we cut to risk level 1 for the only time we ever have, because we were concerned in the aftermath of COVID that valuations were getting too high. Cape-Shiller is now above 40, which far exceeds what it was in 2021, and is now back to levels that have only ever been seen in 1999, 2000, just before the dot-com bubble. Do you think we're in a similar sort of position in the US market right now? Are you as worried about a bubble as there was in 2000?
So in many ways it is similar, and in many ways there are some stark differences. Firstly, the size and market caps of the companies, far bigger now, in the trillions, whereas and the earnings and they are significant, right? So the revenues are significant. They may not be that significant when it comes to the size of the companies. In other words, they're quite highly valued, but the companies are very big now, and deploying a huge amount of capital. So those are the two driving factors now, which present some risk. These are companies that hitherto have been very good deployers of capital, have been hoarders of their profits, paid them back to shareholders by having share buybacks, and had no debt on their balance sheets. They're now deploying huge amounts of capital in areas where the return is certainly not guaranteed, and there's some competitiveness for that return, and the balance sheets are being gradually eroded by raising debt. Shareholders aren't being paid as much through share buybacks, and so on and so forth. So those are the risks now. The risks before were the fact that there were no earnings, the companies were pretty small, there was a huge IPO frenzy, and it was a bubble of small cap internet speculation, as opposed to now where it's a huge capex investment program, which may or may not reap the benefits that the current consensus appears to be bought into, by companies that, by the way, up until now have been very good deployers of capital. And the question is the deployment of this capital going to produce returns that justify the current valuations over the next 10 years? Because if they don't, then the valuations will likely suffer.
And if we look at the history of Cape-Shiller, these are times when it's never been done before, right? Perhaps this time it is different.
That's right. And the Cape-Shiller multiple or index, which is a reflection of a multiple or a valuation, usually gets reverts to mean by two ways. Stock prices fall, which tends to happen quickly, or earnings rise, which tends to happen slowly. So in the first instance, it happens over a short period of time, and that's fine. And we look at that and then we decide whether we need to increase our risk. If it happens over long periods of time, which it has happened before in many cases, in consumer stocks in the 80s and 90s, and then software companies in like Microsoft, where the stock price did nothing for 10 years, the earnings carried on going up very steadily, and eventually the valuation went from a 30 plus multiple to a sort of mid to low teens multiple. I think it got to at its low, which became quite a compelling buy point for Microsoft.
Yeah, and the Nifty 50 in the 70s were
correct,
completely stationary while the rest of the market so there's the two solutions, and it's often a combination that the expensive stocks can fall and the other stocks can just catch up, and in either case you're better off being in the other stocks, which is
that's right. Yeah, and the other stocks, by what you mean, are the value stocks, I guess you can call them, the non-highly valued stuff, where we see some opportunity. And as I was looking at a 30-year graph of value versus growth in the United States, and it's this beautiful saucer shape, which is now turned up for the last several months. That's the area we're in. We've got some funds in that area. There's a whole bunch of stuff in the United States and elsewhere in the world which has been neglected or overlooked because of passive indexation, where all the capital goes into the top 500 companies, whereas you've got thousands of other perfectly decent companies, in fact, very good companies, generating lots of profits and returns to their shareholders, but have been overlooked because the fund flows haven't gone to them. And that's a great opportunity, right? Because when capital isn't going to an area and that area is good, that provides a good opportunity.
Right. Okay. Well, as often, we've gone over our time, I think. I finished by saying that, our defensive position isn't that defensive. It's a case of we're looking for diversifiers. It might look like we're underweight risk, but our risk is underweight when judged against the market, not judged against the way that we see opportunities. We remain fully invested.
That's right.
Well, thanks very much, Eduardo, and speak soon.
Cheers, Richard.